Hi. As we said in last lecture, that there are 4 different classifications of financial markets. Number 1, debt and equity market. And as we said, the main instrument for debt market is bonds, and with respect to equity, with respect to equity is stock. Bondholders has no risk, while with respect to stockholders, high risk. With respect to voting power, there is no voting power for bondholder, while there is voting power for stockholders. The annual payment received, or the periodical payment received by bondholder is known as interest, while with respect to stockholders, it's known as dividends. Bonds has a maturity date, while stock there is no maturity, as you are one of the owners. Maturity date with respect to bonds can be short, intermediate, or long. And as we said, short is 1 year or less. Intermediate from 1 to 10 years, and long more than 10 years. So this is the first classification. Number 2, primary market and secondary market. Primary market are financial markets in which securities are sold to initial buyers. Are financial markets in which securities are sold to initial buyer. This means that there are 2 main players in this market: the issuer and the initial buyer. Initial buyers are going to buy securities from the issuer of the bond or the stock. This is primary market. What about secondary market? Secondary market are markets where previously issued securities are resold. Returning back to our example, that there is an issuer NG would like to borrow money or to get money to make any expansion in her company. So she is going to issue bonds and sell bonds for the initial buyer. So Ahmed is the initial buyer of bonds and stocks. The word securities means bonds and stocks. So this is, as we said before, the primary market. Now Ahmed would like to sell these stocks again to anyone else. Ahmed is going to sell to Mr. A or Mr. B. So this is reselling of previously issued securities. It is not a newly issued securities. Okay, so this is reselling of securities. So this case is a primary market, and this case is a secondary market. Okay. In case of secondary market, the issuer is not going to get any additional money. To make it more clear, NG would like to borrow $1 million. As a result, she is going to issue securities to be sold for Ahmed. Okay. Now Ahmed owns the bond or the stock. Ahmed needs money, so he is going to resell these securities to A, B, C, anyone else. So this is the case of the secondary market. If Ahmed is going to resell the bonds, do you think NG is going to get any additional money? No. So in case of secondary market, the firm, the issuer, will not going to raise funds. Classification number 3. Money market and capital market. Money market and the capital market. Here we are going to talk about the maturity date. It's a classification based on maturity. Money market is related to selling and buying of short-term securities. While capital market is related to intermediate and long-term securities. Classification number 4, exchange and over the counter. In case of exchange market, they are markets where buyers and sellers of securities meet together in a central location to trade securities, just like stock markets. Egyptian stock market, New York stock market, and so on. Buyers and sellers meet in one central location, which is the stock market, in order to sell and buy securities. What about over-the-counter market? Over-the-counter markets are financial markets where dealers at different locations declare prices of their securities and stand ready to buy and sell securities. To make it easier, just try to think about it in case of cars, not financial market, just like car market. We would like to buy a used car. So if you are going to go to a car market in Nasser City, for example, this is an exchange market. Buyers and sellers are going to be located in one place, in one central area, in order to buy and sell their cars. While if you are going to buy to any broker, this is an over-the-counter market. Any dealer or broker, this is an over-the-counter market. Okay, these are the 4 different classifications of financial markets. Just like financial markets, as we said last lecture, that there are direct and indirect. Here we talked about the direct way. What about the indirect? Indirect, so there are financial intermediaries. What are the different types of financial intermediaries? Last time we said that financial intermediaries are a mediator between lenders and borrowers, savers and spenders, people who have excess money and people who have shortage of money. So what are the different classifications or types of financial intermediaries? We can classify financial intermediaries into three main groups. Depository institutions, contractual saving institutions, and finally investment intermediaries. Group number 1, depository institution. For each group, we would like to know what are the types of institutions included in this group, what's the main source of income, and how they are going to use this money. Number 1, depository institutions. This group includes number 1, commercial banks, specialized banks, saving loans, association, and finally credit union. The four types of institutions are based on deposits as a main source of income. This is why it's known as depository institutions. So they are going to depend on deposits. So the main source of income for all of them is deposit, which means that if you have excess money, you are going to deposit, you are going to put it in the bank as a deposit. What are the types of deposits? Mainly there are three different types of deposits in any bank or any financial institution. Checkable deposits, saving deposits, and time deposits. Checkable deposits, they are deposits in which you can write checks. There is no or very small interest rate on a checkable deposits. Saving deposits, you cannot write checks on saving deposits, but you are going to get higher interest rate compared to checkable deposits. With respect to time deposits, mainly it has a maturity date. Of course, you cannot write checks, and it has higher interest rate compared to saving account or saving deposit. So all types of depository institutions can have checkable deposits, saving deposit, and time deposit. Okay, number 1, commercial banks. Commercial banks accept all types of deposits and use this money to make loans. Make all types of loans. What are the types of loans? Consumer loan, if you would like to buy a consumer product, such as you would like to buy mobile phone, okay, so you are going to buy on credit. This is a type of consumer loan. Okay, commercial, or known as investment loans. If you would like to make an investment project, so you are going to get an investment loan. And mortgage loans, this is related to buying a new house, a new building or land. Okay, so commercial banks are going to accept all types of deposits and make all types of loans. Number 2, specialized banks. Specialized banks are related to developing a specific sector. So you would like to accept all types of deposits in order to make a development in a specific sector. So you are going to give loan for those who are going to improve or increase production of this sector. So it's accepts all types of deposits to develop. Say for example, if the bank is related to agriculture sector, so this bank is going to accept all types of deposits and give loans or make loans to those who are going to work in agriculture fields, or who are going to increase agriculture products. If it's related to export, so you are going to accept the deposits and give loan for investors who are going to export their products abroad, and so on. Number 3, saving loans association. accept all types of deposits, but mainly saving deposits. And these deposits will be used in order to make loans related to mortgage. So it's related to only one type of loans, which is mortgage loans. Number 4, credit union. Credit union, it's related to members of an institution. Okay, it's not a bank in which anyone can make deposit in this bank. No, it's related to a specific company, workers in this company, or university, and so on. They accept deposits and make consumer and mortgage loans. Group number 2, contractual saving institutions. This group consists of two main types of companies or institutions: insurance companies and pension funds. From its name, contractual, so there is a contract. So in case of insurance companies and pension funds, both of them are going to be based on contract between the insurance company and the insurer, or the pension fund and the person and the government in case of pension funds. Okay, in case of insurance company, you are going to pay premium. So the main source of income is premium. In the contract, you are going to pay premium monthly or quarterly or annually and so on, and get money back in case of fire, causality, death, and so on. Okay, so until you are going to get your money back, what is going to happen with this premium? In order to make profits, the company is going to collect this money to buy securities. So insurance premium will be used to buy securities. Bond and stock that make profits. What about the case of pension fund? In case of pension fund, it's like a contract between the government and the employee to provide retirement income after being retired. Okay, and there is a contribution, monthly contribution a part deducted from his income monthly. This is the main source of income for pension fund, its contributions. And this money will be used to invest in securities. Group number 3, investment intermediaries. All of them are not depository institutions. Okay. They can be finance companies, mutual funds, and the investment bank. Number 1, finance companies. Finance companies make loans but do not accept deposits, while their main source of income is issuing and selling securities. Okay, so the main function of finance companies is to issue and sell securities in order to get money, to use them to make loans. Mainly these loans are mortgage loans. Number 2, mutual fund. Mutual funds are going to hold a portfolio of securities and sell shares to individual savers. Say, for example, there are 3 different companies who would like to sell their securities. Toyota, PepsiCo, and as Steel. They are going to buy bonds and stocks from Toyota, from PepsiCo, and from Steel, and then make a package, a portfolio of all of them together, and sell it. So if you would like to buy, you cannot buy Toyota only or PepsiCo only. You have to buy the portfolio, the package. So mainly they are going to sell shares and buy securities. They are going to buy securities from the 3 companies and make it like a portfolio and sell it as share. Okay, so the main source of income is selling shares. They are going to use this income to buy securities. Number 3, investment banks. Investment bank is not a bank. Which means you cannot deposit money in investment bank. It's an advisor. That help corporations to issue and sell bonds. They are doing a primary function which is known as underwriting securities. Say for example, I would like to borrow money. But I don't know how to do this. So I am going to ask an investment bank to do this process instead of me. So they are considered to be an initial issuer for the bond or the stock. Okay, so this process is known as underwriting. They are going to sell my own securities instead of me and get a commission in return. This is the end of the 3 types of financial intermediaries. See you next week. Thank you.